video, we're examining probably the most complicated topic in the chapter, and that is dealing with assets that we're going to own for a long period of time, such as office equipment. In this case, we're going to be looking at a copier. We're probably going to have this copier for up to 5 years. And what we want to do is recognize that this copier is an asset, has value to us, but that value is declining over time. And so what we want to be doing is writing off the cost of this over time into an expense. And this expense we're going to call depreciation. So pay careful attention to what kind of accounts we're using and where they show up. We're going to go through all these details. So the first thing that we have to do is figure out how much of this copier are we going to write off each year. And how we do that is we take a look at the cost of the asset, and then we subtract something called salvage value. That is, after we're done with this asset, what do we estimate we're going to be able to sell it for? Someone is going to want a used copier and they would be willing to pay $1,000 for it. So we don't want to depreciate that away because that's the ending value that we'll have before we sell it. So $12,000 ends up being our depreciable cost, meaning how much we're going to write off. And then we also have to make another estimate. Depreciation is full of estimates, but it's the only way that we can accomplish what we need to with these kind of assets. We want to recognize them as an asset and then write them off over time. So we estimate that we're going to have this copier for 5 years. And then we also need to take a careful look at the dates of purchase. So let's say we're recording depreciation for an entire year, but we only owned the copier for 2 months. We purchased it on November 1st, and we owned it November, all of December. So we want to also look at the fraction of the year that we owned it. So in 2008, we owned it 2 out of 12 months. Okay, now we're ready to make our depreciation calculation. We take our depreciable costs that we calculated first, divided it by 5 years, and that's going to come up with the annual rate of depreciation every year, how much we're going to write off. But then we need to multiply it by the fraction of that first year in 2008 that we owned it. So it ends up that our depreciation for 2008, when we're all done, will be $400. So when we bought the office equipment, we would just record it as an asset, $13,000 cost, assume we paid cash for it, $13,000. So that gets it on the books. But then at the end of the year, we want to record our depreciation that we calculated. So our adjusting journal entry to record the decline in value of this asset, or our write-off in the value of this asset, will go to something called depreciation expense. That is an expense account going on the income statement, $400. Now there's no cash being paid out. This is just an adjusting journal entry. How we want to keep track of the write-off of that asset is to an account called accumulated depreciation, and I'll show you how that shows up on the balance sheet in just a minute. But this is basically a reduction to the asset account. It's called a contra asset account, accumulated depreciation. So how this will look in the ledgers is that we'll have office equipment, $1,300. End of the year, we'll have accumulated depreciation to the contra asset account, $400. And then we'll recognize the expense of $400. Let's look at, this is probably the most helpful way to look at this. Let's look at the balance sheet, how this looks at the end. We'll have under assets, office equipment, $13,000, and less accumulated depreciation, $400. Our net book value, remember that term, is $12,600. So we're wanting to show what was the original cost of this item and how much have we written off so far. This will accumulate every time we write something off. It'll add to this. So very important to be comfortable with how this shows up on the balance sheet, and that'll help you with the journal entries made for depreciation.